Hello and welcome. In my last video, I compared the HYLD ETF with the S&P 500 index and highlighted some similarities and differences between them. It was quite well received and I got a few suggestions as well. So based on that, in this video, I'm going to compare the following covered call ETFs, which are all based on the S&P 500 index. Each of the three ETFs you see on the screen is designed to give you a return similar to the S&P 500 index, but there are differences in their covered call strategy as well as the way the funds are structured. If you have seen my previous video, you already know quite a bit about HYLD ETF, but ESPX from Evolve and USCL from GlobalX are equally interesting. I will compare these ETFs among themselves as well as with VFV, which is the most popular S&P 500 index ETF in Canada. Here are the metrics that I will be using for comparing these ETFs. The first metric will be the covered call strategy. It is the most important metric as it impacts the overall return of the fund. Understanding the nuances and long-term impact of a specific ETF's covered call strategy is important when it comes to choosing where to invest. The next metric is distribution yield. This metric is important in the sense that it helps you understand how much capital you need to invest to reach the income goal that you are hoping to reach with these covered call ETFs. The next metric is the fund structure. At first glance, this may not seem all that important, but it does impact the management expense ratio or MER, and you will see later that USCL has the most unique fund structure among all the three ETFs. Last but not the least, the total return of the fund needs to be compared. Simply looking at distribution yield in isolation is not enough. If the fund is losing value overall, then there is the danger that the yield in the long term may also go down. While comparing the ETFs using this metric, I will also include VFV. This will not only give us an idea of how well the covered call ETFs are doing when compared to one another, but also how well they are doing when compared to the underlying index. Alright, with that out of the way, let's get started with the comparison. When it comes to covered call strategy, there are three important factors we need to consider. The moneyness, which represents how much in the money or out of money the options are written. The portfolio allocation, which tells us how much percentage of the portfolio is allocated to covered call writing. And lastly, the leverage used. The amount of leverage used is an important consideration as some people may not be comfortable with leverage, while others may not mind it if it is resulting in higher income. As we can see in the table, ESPX is the only stock which writes out-of-money covered call options. On top of that, only 33% of the portfolio is allocated for covered call writing. So, if we do the math, at any time at least 67% of ESPX portfolio is available for capital growth. But even within the 33% on which covered calls are written, we are able to capture around 2 to 5% of capital growth. Also, ESPX does not use any leverage. HYLD and USCL, on the other hand, use a much more aggressive strategy. Both of them write at the money covered call options on up to 50% of the portfolio, which means at any time at least 50% of the portfolio is available for capital growth. But on the remaining 50%, you're giving up 100% of the upside potential. In addition, they are also using leverage to maximize the income potential. This aggressive strategy does translate into higher distribution yield for both HYLD and USCL, as we will see in the next table. So, moving on to the next metric, the distribution yield, the table on screen shows us the distribution for each of the three ETFs. As we can see, ESPX, which has a less aggressive covered call strategy, ends up with the lowest annual distribution yield at 7.84%. On the other hand, HYLD and USCL are both about 10%. I have added a second column here which shows you the distribution yield based on the most recent distribution because recently HYLD increased their monthly payout. If they continue with this distribution for the foreseeable future, then moving forward their yield will be over 13%, which is almost 2% higher than what they have been paying out in the past year. This may be due to the changes they made to the holdings within their fund. I have highlighted these changes in my previous video on HYLD. Do check it out if you haven't seen it yet. But now we move on to the next metric, which is the fund structure. Most people rarely pay attention to how the ETF is structured, but this actually has a huge impact on the management expense ratio. The table you see on the screen has three columns. The first column, holdings type, tells us if the ETF is directly holding the companies of the underlying index or if it is using a different method to track the returns of those holdings. As we can see, ESPX is the only ETF which directly holds the underlying companies of the S&P 500 index. HYLD, on the other hand, uses a basket of ETFs which are also managed by Hamilton. This helps them mimic the sector mix of the S&P 500 index, but they end up with a much lower number of companies. Lastly, USCL has the most unique approach where it holds USCC, which is the S&P 500 covered call ETF without the leverage. But USCC in turn holds HULC, which is the S&P 500 index ETF, which actually holds the companies. So basically, it is a fund within a fund within a fund. And this triple layered ETF is what results in USCL having the highest management expense ratio at 2.59%, as we can see in the second column. HYLD, on the other hand, charges 0%, but the underlying holdings cost us on average 0.65%, which is quite standard for most covered call ETFs. ESPX has an expense ratio of 0.69%, which is slightly higher. So, one thing we can conclude from this is that the more complicated structure an ETF has, the more we end up paying in the expense ratio. Hence, even in general, if you ever come across two similar sounding ETFs, but one is charging a considerably higher fee than the other, then you might want to take a look at its fund structure. Lastly, the third column highlights how accurate the ETF is at tracking the index it claims to be based upon. All these ETFs mention the S&P 500 index either in the ETF's name or on the ETF's main web page. However, ESPX is the only one which is actually based upon the S&P 500 index. If you look at its holdings, you will notice that its biggest holding is the iShares Core S&P 500 ETF, which is based on the US stock market and which basically tracks the S&P 500 index, and it has a weightage of about 20%. The remaining 80% of the ETF comprises of actual stocks of companies within the S&P 500 index. So they hold the S&P 500 index in two different ways. One is through the iShares ETF, which comprises about 20% of the fund, and then through direct stocks of companies within the S&P 500 index, which comprises about 80% of the fund. I'm not exactly sure why they do this. My best guess is that they want to give the fund more flexibility when it comes to covered call writing. Remember, writing a covered call on a single stock is much more risky than writing a covered call on an index based ETF, since the stock will always be more volatile and could go up higher than an ETF. So, when you're writing covered call on a single stock, you could be giving up more capital gains. Hence, I think maybe the iShares ETF is primarily for covered call writing, allowing the individual stocks to capture maximum capital gains. I'm not sure if this makes any actual difference to the fund's overall return, but this is my best guess. When it comes to HYLD, it has a sector mix which is similar to the S&P 500 index. However, It holds only the top 91 companies. Basically, it is a more concentrated version of the S&P 500 index. This is not exactly a bad thing, since there are people out there who might be interested in only the top companies within the S&P 500 index. However, it is worth knowing that it is not exactly tracking the index. The same is also applicable for USCL, which again does not exactly track the S&P 500 index. What it is based on is the Solactive US Large Cap Index, as mentioned on the HYLD webpage, which is the primary ETF within its multi-layered ETF structure. If we then go to the Solactive website, it shows that the Solactive US Large Cap Index actually holds the same 500 companies as the S&P 500 index. However, there is a twist. The selective version uses something known as the free float market cap method as opposed to the full float market cap method used in the S&P 500 index. Here is the primary difference between these two methods. Full float method uses all the available shares to calculate the market cap, both the ones which are freely available to trade on the market as well as the ones which are locked in, such as those held by insiders. The free float method, on the other hand, only uses shares that are freely available to trade on the market to calculate the company's market cap. This results in slight variation in the weightage allocated to the company within the indexes. As we can see in this side-by-side comparison of the Solactive US Large Cap Index and the S&P 500 Index. Nvidia is the top company in the Solactive Index, while Microsoft is the top holding in the S&P 500 index. Also, AT&T is the fifth largest holding in the selective version, while in the regular S&P 500 index, AT&T is in the 71st position. So, when it comes to index tracking accuracy, ESPX does the best job. HYLD and USCL are also providing returns similar to the S&P 500 index, but they are not exactly based on the S&P 500 index. With HYLD, it is a more concentrated version, while USCL, with the use of Selective US Large Cap Index, has variation in the weightage of each stock. The final metric in this comparison video, and the one most investors are generally concerned about, is the total return. As income-focused investors, we want to receive a consistent income every month from these covered call ETFs, but we also want to capture as much total return as possible from the underlying holdings. The whole point of a covered call option is that it is meant to be a trade-off between capital gains and income. Hence, to receive income, we are going to sacrifice some capital gains. But it is worth checking out which of these ETFs does the best job of getting as close to the total return of the S&P 500 index as possible. To ensure fair comparison among these three ETFs, I'm only going to compare these ETFs within the time period from July 7th, 2023 to June 7th, 2024. There is an important reason for this. A fund's total return is affected by when it started trading on the market. Take the following example. Imagine a fund that tracks the S&P 500 index and it was launched on March 20, 2020, which was the lowest the S&P 500 index had traded in the past 5 years. As of June 12, 2024, this fund would have returned 125% over 4 years, which would be a year-over-year return of approximately 22.5%. Now imagine another fund which also tracks the S&P 500 index, but this was launched on December 24, 2021, which was a high point after which throughout 2022 the S&P 500 index went down. This second fund would have returned around 25% over 2.5 years, which would translate into an year-over-year return of approximately 9.5%, which is still not bad, but not as good as the first fund which was launched at the lowest trading point. However, if we compare the two funds from December 24, 2021 onwards, which is the nearest common trading point, their return would be identical. In other words, simply looking at all-time returns of funds with different launch dates is not an accurate comparison. For this, we need to take into comparison the nearest common trading period for all the funds, which in this case would be July 7th, 2023 onwards, which was when the USCL, the latest among the three ETFs, was launched. Since I'm making this video in the month of June 2024, I'm keeping the end date as June 7th, 2024, which gives us a neat period of 11 months, just 1 month shy of 1 year. It is probably not the most ideal comparison time frame in terms of length, barely 1 year, but it is the best we have if we want to be accurate. And if I get a good response in this video, I will surely make more similar comparison videos in future as well. So with that detail highlighted, let us get started with the comparison of total return. The table on your screen shows us the capital gains for each fund along with the income paid out in the time frame we are using, and the last column shows the total return. These numbers aren't exactly surprising based on what we already know about these ETFs. ESPX has more capital gains compared to HYLD and USCL. This should not come as a surprise since we already saw that ESPX uses less aggressive covered call strategy, which puts more emphasis on capturing capital gains. HYLD and USCL, on the other hand, have lower capital gains but higher income paid out. However, in terms of total return, all three funds are not that far apart. ESPX technically has the lowest total return, but we must not forget that it is not using any leverage. What does surprise me, however, is that USCL has the highest total return despite having the highest management expense ratio. I wonder if the return would be even better if the management at Global X somehow found a way to structure this fund better and reduce the expense ratio. HYLD's total return, although better than ESPX, is still underperforming USCL. There is one caveat regarding HYLD we need to keep in mind that previously HYLD held third party ETFs, and only recently these were replaced with their own in house ETFs, which significantly improved the fund's performance. These changes came into effect only as recently as January 2024, which is 6 months ago. This table, however, shows its return in the past 11 months. So, what we are looking at is a mixed bag return, which is a combination of its old strategy and new strategy. I have a feeling that within another year, HYLD might catch up or even exceed USCL's total return, given the fact that its holdings are now more streamlined with the fund's objective, and it also has a lower expense ratio than USCL. We will see how that turns out within a year. But now let us compare these ETFs with VFV. As you can see, in terms of capital gains, VFV vastly outperforms all the three covered call ETFs. However, in terms of total return, the difference is a lot less. At the same time, VFV still has a healthy lead of about 7% over USCL, which is the best performing covered call ETF on this list in terms of total return. But there is one thing about VFV that I wasn't aware of when I started making this video and only realized midway through it. It is the fact that VFV is unhedged for currency fluctuations between US dollar and Canadian dollar. This means that a weaker Canadian dollar would mean higher returns in VFV. In the past 1 year, that is exactly what has happened. US dollar has grown stronger than Canadian dollar. So if we look at VOO, which is the same ETF as VFV, but trades directly in US dollars, and this ensures that there is no currency fluctuation, we end up with a different set of numbers. As you may have noticed, VOO still ends up outperforming the covered call ETFs in terms of total return. But now the difference is a lot less, at about 3% when compared to USCL in the same time period. This underperformance isn't exactly surprising to me when it comes to covered call ETFs, since, as noted before, with the covered call strategy, we are making a trade-off with total return to receive income upfront. In the early days of covered call ETFs, funds like HYLD used to vastly underperform the underlying index. But these funds, with their innovative strategies, which are within 3 to 6% of matching the total return of the underlying index over a period of 1 year, should be seen in a positive light. The fact that these funds are quite close to matching the total return of the actual index is quite encouraging. And with that, we come to the end of this video. I'm not going to comment on whether any one of these covered call ETFs is better than the other. That is a decision that you need to make, because depending on what you're looking for, one ETF might be better than the other. If you're looking for an investment with a conservative covered call strategy with more focus on capturing the capital gains, ESPX might be the best choice. If you're looking for a more aggressive covered call strategy with a higher concentration of large cap companies, HYLD might be a good choice. On the other hand, if you want a fund with an aggressive covered call strategy, but whose holdings are more in sync with S&P 500 index, then USCL might be the best choice. So depending on what you're looking for, the definition of the best fund might change. Last but not the least, all the information presented in this video is based on my research, expresses my opinions, and does not count as investment advice. Always do your own due diligence before making any investment decision. If you found some value in this video, don't forget to like, share, and subscribe. Also, do let me know in the comments section if you like these comparison videos and if you would like to see similar comparison videos in future. I'm always open to suggestions. Thanks for watching, and I will see you guys in the next one.